From January 1st, 2026, Nigerian banks will stop playing neutral middlemen and start acting as tax collectors on foreign currency savings under the Nigeria Tax Act 2025. Lenders, including Access Bank, will automatically withhold a 10% tax on interest earned from domiciliary and other foreign currency deposits, remitting it directly to the federal government. For savers, the implication is simple but significant. Interest on dollar holdings will now be received net of tax. While the policy fits into a broader push to standardize tax treatment across financial instruments and widen government revenues, it also raises sharper questions about incentives to save in foreign currency and whether the reform nudges behavior or merely trims returns. Now, joining us for this discussion is Adeyemi Adenuga, investment research analyst, Zedcrest. You're welcome to the show.
Having me. Good morning.
Good morning. Now, for many Nigerians, domiciliary accounts have long been seen as a safe place to earn interest while preserving value. Now, with banks now deducting a 10% withholding tax automatically, what are the first things everyday depositors should be looking out for?
All right. Thank you for having me again. So one of the things that the tax authority is trying to do now is to broaden the tax horizon, right? So prior to now, this area of withholding tax for foreign currency deposits has been a gray area for investors. I mean, for normal investors that save in the domestic currency, that's the naira. We see situations whereby when you save in the naira, what you see is that you pay the withholding tax in the naira. But prior to now, deposits in foreign currency have not really been subject to withholding taxes. Some houses actually charge withholding taxes, but it has been a gray area primarily. But now we expect that now the federal government tax revenue service, that's the Nigerian revenue service, have actually now introduced it and now saying that all individuals must actually pay this withholding tax on their deposits in terms of foreign currency. It's a welcome development and it's a good one for the Nigerian economy. And we also expect that, some investors would likely react to this. And first thing is that, it's important they also understand that these withholding taxes are not withholding taxes on their entire deposits, but just on their accrued interest. And it's just 10% of the accrued interest. For some individuals that have significant holdings in dollars, they most likely would begin to react to that. But we should expect that to, it's part of the new reform, and we expect individuals to comply with it in the near term.
All right, so dollar savings have often been used as a hedge against inflation and naira volatility. Now, do you think this new tax will alter how Nigerians choose between saving in foreign currency versus naira-based instruments?
Okay, yes, I believe it will actually have a large decision, or it will be a factor that investors would likely look into before they hold the currency. Now, first, if you look at the currency market, right, talking about just the trend of the naira against the dollar over the last 1 year, at the beginning of year 2025, we saw how that the naira was trading at around 1,600 naira to a dollar, but currently we see it at around 1,450. That shows that the naira has actually appreciated against the dollar in the near term. So one of the things that this would actually do for individuals is that first, it will want to reassess their needs to actually hold the dollar. So if you are being taxed in terms of your deposits in the dollar, why would you want to hold more dollar? So first things that individuals will want to do is that they would likely want to reassess their needs to hold more FX. And then the second thing is that, it's important that these individuals also understand how this actually affects their income generally. So basically, we should expect that, looking into year 2026, the expectations are that the naira would remain relatively stable. So why lose value on your currency and also be subject to withholding taxes when you can actually invest in another currency that is stable, that is the naira? So most likely we might see some investors react to this by maybe converting their dollar holdings to naira and then investing that in naira, although the naira holdings are still subject to withholding taxes, but now you earn more interest because for dollar holdings you are probably earning a single-digit interest, but for naira holdings you're earning a double-digit interest, as high as say 15% and above. So basically, I think investors will react to that, and we should expect positive conversion in terms of, the rate at which individuals convert their dollar to naira, basically.
All right, so this policy change was basically communicated by banks, but it came in brief notices. Now, do you feel like customers were receiving enough clarity on how this affects their monthly or their annual returns, or are many now left to calculate the real impact on their own?
Okay, while the notice from banks was a short notice, again, this withholding tax implementation is a tax that has always existed in the Nigerian economy. So most likely, we don't expect that individuals would then not understand how it operates. First, it's a tax credit for individuals. It is withheld with the tax authority, and it helps them offset their future tax obligations. So it's a good one for individuals to actually pay this withholding taxes. So I believe that, particularly corporate entities and also individuals, I believe that a large number of them are already sensitized about the withholding tax, and we should expect full compliance with this going forward. And there's also the structure in place for the government to actually implement this, because it's something that has been existing prior to now. So we have that structure in place already.
All right, so one of the concerns that came about with this policy change is the fact that it may discourage savings altogether. Already, Nigeria does not have that big of a saving culture, mostly due to how the economy is at the moment. Now, how would you respond to depositors who fear this move might push people to hoard cash outside of the banking system rather than taking it to the banks?
Okay, so it's a very dicey situation, given that we see some investors that might likely want to maybe hold cash outside the banking system. But except if those cash are illegal cash, it is best for it to be in the banking system, because you earn interest, even though you are not earning the entire 100% interest. Now you are earning 90% of the interest, given that you'll be taxed and 10% of it. But again, it doesn't necessarily discourage savings. First, it would help individuals reassess their need to hold the dollar. Right? If you are an individual or a business that you are holding FX and you don't have any FX obligation in the near term, or you have anything that you're just trying to do with the FX, I think it makes smart decision for you to actually convert that to the naira at this point, given the projection for the currency market going into year 2026. And then, holding the naira outside, or holding the currency, that's holding the dollar or any foreign currency outside the banking system, is not advisable, because first, it doesn't yield any value to you as an individual, and on the other side, it also does not even give any value to the currency and also the banking system. So again, it's just outside the system and doesn't really count into the liquidity in the system. So it's advisable you first, if you don't have any obligations in the near term, that is any foreign currency obligations in the near term, it's best that you just invest this money or convert it back to naira and invest it in naira rather than holding foreign currency. And it's not advisable to hold funds outside the system. So while we might expect some individuals to maybe react to this way, it's advisable that they actually bring back these funds into the banking system just to help liquidity in the FX markets.
All right, so you're speaking from a very educated stance, obviously, but what do you say to the people who are more, in the local backgrounds that we have? How do you then convince them that, it's not advisable for them to hoard their cash? Because a lot of people are working on very limited understanding on what this tax actually means.
Mm-hmm. Right. So, one of the issues about tax and, decisions around tax in the Nigerian economy is financial literacy, right? A large number of persons just continue to ride on information that they see on maybe on WhatsApp and the likes, and it clearly does not signal that that is the right information in that matter. So basically what we should see now is sensitization from the government, trying to sensitize people on, first, the reason why it's not advisable to hold foreign currency outside the banking system, and then the importance of holding this foreign currency in the banking system. So it's one of the things that investors would likely want to react to. But it's going to be a very, very positive. It's going to be a very, very positive investment for individuals if they choose to put it back into the banking system. So first, we need financial literacy to actually achieve this in the Nigerian economy.
All right, so banks are remitting the tax directly to the government. Now, the process is meant to be a seamless one. So from a transparency standpoint, should customers receive clearer periodic breakdowns showing exactly how much was withheld and when?
Yes. So ideally, the structure just shows how the withholding tax is actually introduced. So basically, when a financial institution actually pays a withholding tax on your behalf, what is expected is that they remit it in line with your NIN. Now that the Nigerian Revenue Service has actually allowed that NIN can double as your tax identification. So they remit it in line with your tax identification. Now, for you as an individual, when you go to remit your other tax, say for instance, your company tax or your income tax later on, you are liable to pay lesser given that this has been withheld for you. So you see that, and I encourage individuals to always have access to their tax portal, check the portion of tax that have actually been remitted for you. So if you make a fixed deposit with a bank and you expect that a portion of a withholding tax was debited for that fixed deposit, it's important that you go back and check your portal to confirm that this was remitted on your behalf. If it wasn't remitted, then it's important that you reach out to the financial institution to do the needful for you. So again, while banks might always want to, your bank statements will always capture that detail, it's also important for you as an individual or a business to always go back to check the tax portal to reconfirm that this was actually remitted on your behalf.
All right, so the policy is anchored in the Nigeria Tax Act of 2025 and framed as part of wider tax reforms. Now, in your view, what was the core policy motivation for bringing foreign currency deposit interest into the tax net at this point?
Okay, so a number of things accounted for this. So first, we saw the parts where the government, as you know, that the Nigerian economy is largely dollar financed. And the reason why I said that is because if you look at a large amount of the imports into the economy, they are largely based on the dollar figure. That is, if you are investing or you are importing money, you are probably paying dollars to actually import that commodity. So the dollar plays an important role in the Nigerian economy. So what we now see now is that, one of the reasons why the government introduced this is first to help individuals reassess their need to actually hold foreign currency, say the dollar, the pounds. First, it helps them to reassess their needs to hold this foreign currency. And the second part is how that the government is also trying to reassess the gray areas in terms of tax implementation. As I said earlier, withholding taxes have always existed prior to now. We see it for domestic fixed deposits investments. But going forward, we've also seen some houses also debit withholding taxes for foreign currency deposits. But now the government, but it wasn't really explicitly stated, but now we see that the government is now explicitly stating it that all foreign currency deposits are subject to withholding taxes. So again, it's a positive one for the government in terms of revenue. And then it's just a way of making it clearer for individuals and businesses in the market that withholding taxes are now taxable on foreign currency deposits.
All right, so let's take a look at the different forms of taxations at this point. Interest on other financial instruments already attracts various forms of taxation. Now, how does this new treatment compare with what investors currently face on treasury bills, bonds, or other fixed income products?
Okay, so I think it brings everyone to par now. And by saying that, if you look at it, sometimes in October 2025, we saw how that the FIRS, now the Nigerian Revenue Service, clarified that withholding taxes on treasury bills are now subject to withholding taxes. Right, prior to now, sometimes in 2015, the government exempted treasury bills and federal government bonds from withholding taxes. But now we see that withholding taxes are now going to be charged on treasury bills investment. That is, the interest accrued on treasury bills investment are now subject to withholding taxes. Now it brings them to power because if you look at it now, fixed deposits in Naira subject to withholding taxes, fixed deposits in foreign currencies subject to withholding taxes, fixed deposits in commercial papers subject to withholding taxes, fixed deposits in treasury bills subject to withholding taxes. While the only part where we see a positive part is just in terms of bonds. While bonds, they remain exempted to any form of taxes. So, it's a good one. It's just a way of just making more revenue for the government. and also making it easier for individuals to actually remit their taxes, because now the withholding tax is a tax credit for any individual that chooses to, or that have any of those investments. So later on, if they choose to maybe pay their income tax later on, or any form of tax, they have the right to actually pay less of that, given that they've withheld a portion of that tax before with the tax authority.
All right, so with tax policies, they often include thresholds or exemptions. And the point of this, of course, is to protect vulnerable groups. Now, were any carve-outs provided for retirees, small savers, or low balance accounts, or does this apply uniformly to all foreign currency interests?
Okay, so at the moment, I mean, this is a uniform investment, except for pension houses, right? This is uniform across board, except for pension houses. So pension houses are kind of exempted from these withholding taxes. Aside the pension houses, the other form of investors are subject to, or their investments are subject to this withholding tax, and the government has put in structure in place to actually capture these taxes.
All right, but do you think that there should be more when it comes to exemptions?
So, I mean, a large amount of the Nigerian tax brackets, talking about, say, for instance, the small businesses and the likes, I believe they should be a kind of like more tax credits for them and an exemption for that tax bracket, given that, I mean, the new tax system is a progressive tax system that allows individuals that earn on the lower brackets to pay lesser taxes as compared to those at the higher brackets. While the withholding tax is a uniform tax, that is a 10% tax across board, we expect that the government should likely maybe give some exemptions to small businesses and some businesses that operate within a certain low threshold. But at the moment, pension houses and some other forms of houses are just the people that are exempted from this form of withholding tax.
All right, so beyond individuals, many businesses hold sizable foreign currency balances for operational needs. Now, what does a 10% withholding tax mean for their cash flow management and treasury planning?
Right. So on one part, I mean, it's going to have a negative effect on their cash flow management, given that, I mean, if you look at it, you'd see that they would have to pay 10% of their accrued interest, and some of these businesses did not actually plan for this prior to now. But for proactive businesses that have operated in Nigeria for a while, they most likely would have envisaged this policy prior to now, because withholding tax has always been an existing tax system in the Nigerian economy, right? So what we should see now is that, and given the structure of it, I mean, it's a withholding tax, so it's more or less like a tax credit for individuals. So the net effect is likely going to be, I mean, in the near term, in terms of their operations, is going to limit the cash they can have. That is, it's taking about 10% of that withholding tax, but it's also of benefit to them, given that they can now have that portion as a tax claim when they want to remit their taxes to the NRC, to the NRS. So basically, it's going to affect them on the near term, but it's also going to be of best benefit to them at the end of the year when they are remitting their taxes to the government.
All right. So while the government presents this as a revenue and standardization measure, policy shifts rarely stop at one step. Now, do you see this as a one-off adjustment or the beginning of broader changes in how investment income is taxed across Nigeria's financial system?
Okay, so I believe this is the beginning of a new tax system, and this has come to stay, and I believe it will continue to stay. Given that, I mean, it's something that has always been a gray area, but now that the government has expressly stated it in the new tax rules, we should expect that this would continue to exist going forward. While we expect that, I mean, some investors might likely react to this by, say, for instance, converting their FX to the domestic currency, or by also, or maybe even holding some of their FX in cash. What we'd likely see is that it's going to continue to exist. I mean, the tax authority or the new tax regime has come to stay. And the most important thing is that individuals and businesses should just learn how to adapt to it, and also visit different tax consultants just to see ways through which they can actually effectively manage their taxes as a business. But generally, I believe it's a new tax regime that has come to stay, and it will continue to be there in the near term.
All right, so before we let you go, finally, how do we ensure transparency and accountability throughout this process?
So, transparency and accountability. So first, the structure has been in place. On the side of the banks or the financial institutions, when they remit these taxes, they remit it to the NRS, and the NRS, on the side of the investors or the owner of these funds, they can go to their portals to actually check this. So it's a bit transparent, right? So if a bank remits on my behalf, I can go to my portal to reconfirm that the bank has actually remitted on my behalf. So it's transparent for all parties in this case, and then it's easier for the government to also track this going forward. And given the fact that, these taxes are debited at sources, so it gives less room for individuals to actually evade this form of taxes. So, the banks debit these taxes before they pay out the net income to the individual. So it's well transparent, and I think we are good to go in terms of the implementation of this withholding taxes on foreign currency deposits.
All right, that was investment research analyst Zedcrest Adeyemi Adenuga. Thank you very much.
Thank you for having me.